Get the slide to move. I'm Tyler Henning. I am the marketing manager here at Provident and Physician Tax Solutions. With me is David Auer, our tax guru, financial everything, and man of many letters behind his name that we love going to for all things tax planning and financial advisement. I always like to hand this off to David because he does know the fine print. I don't know it as well. So, David, take it away.
So this is just the general disclaimer that everything we're going to talk about here basically is those are today's topic is about the pending legislation on relating to taxes here in the United States, and then none of the strategies, any of the ideas we talk about are intended to create any penalties for anyone, obviously. But definitely, if you're going to implement any recommendations, seeking competent tax advice is always a recommended next step.
Cool. We always like to get started talking about our model. It's something we might reference during our discussion tonight. If you're an existing client, you've heard us talk about this, and if you're a prospective client, this is something we're going to talk about a lot if we start an engagement. We kind of built this around Maslow's hierarchy of needs, but it's focused towards your focus towards financial freedom. Starts with saving, moves on to protecting and building, retiring, and having an impact in those retirement years. Our process works off of that model. It starts with getting a strategic blueprint. This is something really unique. You answer a questionnaire and you send us a couple of years of tax returns. Our team looks at it and gives you a really great assessment and recommendations of where we believe you can save through effective tax planning. From that strategic blueprint, if you decide that working with us on implementing those recommendations is your next step, we have a great team here that will help onboard you. They'll explain why you're setting up certain fees, how we're getting QuickBooks and other tools set up, and how those will be effective for you down the road. Three, after that onboarding and you understand what we're doing and we understand your situation, and start doing the doing part of this, the implementation. And then something really unique to our firm is a quarterly pulse. Every 90 days, we touch base and talk about key issues, and the key issues each quarter align with something you need to be thinking about in that quarter. David?
Thanks, Tyler. So tonight we're going to be talking about the going back a little bit in time. If you joined us for the last webinar, we talked primarily about the most recent proposal that the House Ways and Means Committee had announced about a month ago. Basically the Build Back Better Act, which is the $3.5 trillion reconciliation budget proposal. What we're going to start, and if you missed that webinar, I highly encourage you to go back and listen to it. We went into as much detail relating to the tax aspects of it as we've had information regarding. It's a pretty massive bill, so there's a lot more in it, and we just selected the tax provisions to talk about. Tonight, we're going to give you the latest or the update on that proposal and where it is in negotiations, and then review the laws or the actual legislation that was passed earlier this year and how it's going to affect your 2021 tax return, assuming that anything in the new bill isn't going to change that, and then show you how the legislation has evolved over the course of the year leading up to this most recent legislation, as you'll be able to see things that are being taken off the table as the negotiations continue, including the most recent changes which just happened today. So we'll talk a little bit about that, and then moving next to what we think is coming up next in the legislation. Our goal tonight was that we had hoped that this legislation, the Build Back Better Act, would have gotten a little farther through, at least through the House and on into the Senate, and we would have had a little bit better idea of where we would stand at this point, because right now we are in that critical window of year-end tax planning. So we're in the middle of October, and if any of you have worked with us in the past, you know that about this time of the year is when we switch or we pivot and turn all of our attention on implementing strategies that need to get put in place by the end of the year to minimize the current year taxes. So right now we're in a little bit of a holding pattern. So far over the last 6 months, it's been a hurry up and wait to see what happens in Congress. So it's taken a little bit longer than what we thought. We thought we'd have something by now, but that hasn't happened. We'll talk a little bit about where we think the timing of what we think will happen, when things will happen, and then what we see happening as far as depending on what these latest negotiations are coming down to and what may still be on the table. And then second to last, we'll talk about how you can respond to these. Always starting earlier rather than wait until the last minute, or worst case, waiting until next year to try to do tax planning for 2021 when the opportunity may be no longer available. We'll talk a little bit about how to respond to where we are right now in what I would consider are somewhat uncertain times, but waiting until the legislation gets passed may be too late to take action. So there's some things that we'll be talking about that you can still try to do this year, even though Congress is still negotiating. And then we'll open this up for questions. And then at the end, we'll talk about our next two webinars that we have scheduled. The one coming up in 2 weeks from now is going to be one about tax planning for year-end tax planning for businesses. My hope is in 2 weeks, we'll have a much better idea of where the legislation is, so we can we can include whatever the legislation is in our year-end tax planning recommendations. If not, it'll be somewhat of a hybrid combination to say, okay, here's what we know right now is the law that you can go ahead and put in place. Here's what we think the law might be, or to be prepared for what the law might be, and what those strategies might look like as well. And then 2 weeks after that, so about a month from now, we'll talk about the same strategies on the individual level. And we'll hopefully by then we'll know whether this bill is going to actually pass this year. It looks like the trend is going to be if it doesn't pass this year, it'll probably be taken up sometime next year, because at the current moment, when one party controls all the the House and the Senate and the presidency, they have a short window of time to pass tax legislation before potentially the midterm elections change that a year from now. So let's first go back in time and just briefly review the tax legislation that has happened so far leading up to this latest Build Back Better Act. So where we are right now, so if you remember from some of our previous webinars back in the spring, we talked a little bit about the American Rescue Plan. So that was actually signed into law back in mid-March. We'll talk about how what changes happened there. Very little tax changes happened in that law. That was mostly COVID related and infrastructure, starting down the infrastructure pathway. Then what started back in March and then has continued through the summer is a lot of plans or bills that have been proposed under various names. The American Jobs Plan, which was initiated by the White House, as well as the American Families Plan. Those have both been proposals, but what you'll see are the key elements in that. Those proposals are what now what remain from those proposals are what now constitutes what we have in the $1.2 million infrastructure package, which is really part one of the Build Back Better Act, and then the second part, which is currently the $3.5 trillion budget bill. So we'll start with that overview. There was a leaked memo back in July that indicated that there was starting to be some agreement on some of these provisions. So we'll share with you what those terms are. So let's first start with where we are with the budget, the Build Back Better Act. So the negotiations, if you've been reading the headlines, have become quite intense over the last 2 weeks. So yesterday, President Biden's talks with the Democrats resulted in him lowering his expectation that this bill would not be $3.5 trillion of spending, but down in the range of 1.75 to 1.9 trillion. If you look through that to say, what does that really mean? How some people have interpreted that is many of the programs that are in that Build Back Better Act or that proposal, what they did is they didn't change the programs, but they just changed the time frame through which those programs would be funded. So they just shortened the timeline, not necessarily what that money was actually going into as far as a from a policy standpoint. So that's still subject to tremendous debate on which of those programs are necessary at this point where we are as a country. This week, the Senate Democrats started scaling back on what you might have also heard about the as part of this bill. That financial institutions will be required to provide the IRS with information on any bank accounts that initially had up to $600 a year in transactions, which would pretty much involve almost every working person's bank account or checking account. They increase that to up to $10,000 annually. Some people say that that's really not a significant change, and so it's still being heavily debated on and contested on whether or not we should allow the IRS to have immediate access to people's taxpayers' checking accounts. Last week, as I mentioned, President Biden started acknowledging that the $3.5 trillion budget spending amount would possibly need to be reduced. A lot of that is being led by Senator Manchin, Democrat out of West Virginia. He personally has a $1.5 trillion cap that he claims that anything above that is fiscal insanity. And then he also mentioned that the deadline of October 31st, which has been set by the Democrats to try to get this to the House for to vote, may not be met. So where we stand right now is you'll see a lot, probably more in the press over the next coming weeks as President Biden is traveling around the country promoting this agenda, as well as identifying kind of a divide and conquer, negotiating with individual congressmen to get their vote on this, and then hopefully submit it to the House to see if it'll pass. So hopefully that might happen in October. There's no guarantee. If it doesn't, it may go on in negotiations and then be pushed into next year. So obviously, our concern is the more time we have to plan for our clients, the better. Anything that happens, too late in the year, sometimes we're handcuffed to be able to do anything about it. But if we know what possibilities may happen, we at least can plan for those possibilities by starting earlier. So that's where we are with the Build Back Better Act as of today. If you remember back early in the year, we had the American Rescue Plan. So you'll notice that most of these bills had the word American in them to make them seem somewhat patriotic. If there's any such thing as feeling patriotic when you end up having to pay more in tax, but this was a bill that was passed by the House and the Senate and was signed into law. It mostly included economic support, increasing child tax credits, additional aid for people that had really been suffering through the pandemic. So it wasn't. It was more of a infrastructure, if you will, on healthcare and COVID related needs, rather than highways and railroads and alternative energy sources like the most recent House bill is. So it focused more, like I mentioned, more on the economic side, didn't really have any major tax law changes. However, what it did set is the stage for, okay, now we've got the economic stimulus, now how do we pay for it? And then that started coming out in the next couple of bills that were proposed by the White House. The first one being, Tyler, if you want to move, click, was the American Jobs Plan. So this was came out in late March. Now this was a $2.5 trillion add-on, and it was going to then spend more money on the infrastructure. So the first bill was more COVID and pandemic related, helping individual taxpayers. This was then the idea that we need to also put money back into the infrastructure that'll drive employment as well as uh, help the economy recover. So that you'll see components of this. And now this was a proposal, so it's not law. But you'll see components of this building up to this latest legislation that is currently being considered. So that this American Jobs Plan did add the first of many or future tax increases. This one proposed that the corporate tax rate get raised up to a rate of 28%. The current corporate tax rate right now is a flat 21%, and the one that most recently is being proposed is a progressive rate that starts at 18% and then goes all the way up to a surtax of much higher than 28%. But anyway, this was this was the first introduction to increasing the corporate tax rate, and did not yet have any effect on individual income tax rates. And then the American Families Plan, which that was then promoted about a month later. That was another $1.8 trillion bill that was going to accompany the American Jobs Bill. This was going to, and a lot of these have now been absorbed into the Build Back Better Act, but now provided 4 years of free higher education, direct support to children and families, which now is more of a prepaid preschool or free preschool for younger children. And then basically several extensions and continuations of some of the tax credits and benefits for lower income taxpayers, and including the child an increase in the child independent care tax credit, which does impact clients that are at a higher tax bracket. So that was the American Families Plan. This one was where that introduction to having financial institutions start reporting information based on how much activity was in bank accounts. That was where that proposal had first been introduced. It would increase the budget for the IRS to hire more auditors, which then therefore would increase the risk of, or the percentage of audits that are going on. Increase the top individual rate. So this was the first effect on individuals from a tax rate standpoint. Increase their rate to 39.6%. And then it added another surtax on households making over $1 million. So some of these proposals have survived through the latest evolution of bills. Others have started dropping off, and I'll mention a couple of those as we go. So the good news is they didn't get the wish list that they started off with earlier in the year when they introduced these bills. And obviously, if now the spending budget is going to go from 3.5 down to 1.75, we're looking at about another 50% haircut on potential taxes, assuming that that it's not just the timeline that gets reduced on a lot of these proposals, but actually the dollars that go into these programs. So this American Families Plan, if you remember reading about this, was going to eliminate the step up in basis of property at the end of life, and for anyone who had gains in excess of $1 million. So in those situations, your heirs would have not only both an income tax issue, but also potentially an estate tax consequence as a result of this change. It closed a loop, what they perceived as a loophole, and carried interest for hedge fund partners. And then it also added, which now is no longer part of the latest legislation, an additional 3.8% Medicare tax on anyone making more than $400,000. As you might know, there's a FICA wage cap every year, wage base every year. Right now, it's a little bit over $142,000, and it increases every year. This would have reinstituted a 3.8% Medicare tax on income over that 400,000. So the good news is that piece is no longer here. Now, fast forward into July, before the Senate had approved the infrastructure package, there was a memo that came out, sent to Politico. I talked about this bill was going to be debated starting in October. Corporate rate was going to be at about 25%. We're going to have a minimum corporate tax of 15%, top ordinary rate of 39.6%. Capital gains was going to be increased to 28%, and no more tax benefit for carried interest. So that leaked, that came out, which gave us an indication of what the next step was going to be, which was the what you might have read in July, which was this bipartisan agreement on part one of two-part infrastructure bill, where they were going to basically sell everybody on the idea of putting money into much-needed infrastructure improvements. Some money going into areas that had it was the most ever spent on that particular item in the history of the U.S. So a lot of this was a dramatic investment in these areas, some needed, um, but it was a very ambitious $1.2 trillion proposal. That was the Senate actually passed that by bipartisan agreement with the House in August. What they told us at that point was there was another part coming, which is now how we're going to pay for all this. So that then led, which on the next slide, to the Build Back Better Act. And so that's what you might have been reading mostly about over the last month. So on September 13th, the House Ways and Means Committee released a proposed budget for how to finance up to $3.5 trillion of additional infrastructure costs, basically an accumulation of all the proposals that had survived the earlier bills. And then this basically was the bill on how the taxes were going to be changed to be able to pay for all this. So keep in mind, this has not gone to the full House yet for a vote. So it just came out of the House Ways and Means Committee. The Democrats are not all in agreement on this bill. That's why there's been very heated, very heavy negotiations that have been going on for the past month, all the way up to this week, with the idea their goal is to still try to get it to a point where they can submit it to avoid a vote by the end of this month. And so if you'd like to have more information on the Build Back Better Act, I'd recommend that you listen to our webinar 2 weeks ago. It gave a lot more detail, but here's just a highlight of some of the changes. The top rate, as mentioned before, has survived, to where the top rate for families over $400,000 of adjusted gross income will go up to the 39.6% rate. It's a little deceiving to think that that's going to jump from 37 to 39.6, because actually the 32% bracket right now is what married filing joint taxpayers pay on $400,000 of taxable income. So it actually is going to jump their marginal bracket more in the neighborhood of over 7.5% increase, rather than just the 2.6%. As of right now, there's no changes in SALT limits. What that means is that you're still limited to deducting state property, state sales tax, and state income tax to $10,000 a year. So there are a lot of people out there listening to this webinar that know that they pay a lot more than $10,000 in property tax, income tax, and sales tax during the year. And so the hope was that that would somehow find a way into this bill. So far, that's not the case. That was what the law was back before 2018, but that got capped at $10,000 since then. It's basically a 5% increase in the capital gain rate. So now the top marginal rate for capital gains goes from 20% up to 25% for those who have income over 400,000. The QBI deduction, which several of you who have income that qualifies have enjoyed the benefit of having a 20% deduction. That's now going to be phased out if you're single over 400,000, if you're married over 500,000. And then the 3.8% Medicare surcharge. This is a brand new tax. This is going to start applying to pass-through entities that you have a non-passive income. You receive a K-1 from a non-passive business or investment. So that's basically turning that income into self-employment income. which is going to change how tax planning is done with a lot of our clients who have S corporations who attempt to minimize some of that Medicare tax by keeping their W-2 salaries as low as reasonably possible. Some of the other changes to this involve the corporate tax rates increasing up to 26.5% from right now a flat 21%. It actually has it starts at a progressive rate for the first $400,000 of corporate tax, or I'm sorry, taxable income. The rate is actually 18%, which is actually lower than the current 21%. So that's going to increase the popularity of using C corporations or taxable or regular corporations in conjunction with S corporations when you do tax planning, because you'll be able to shift income possibly from as high as a 39.6% bracket down to a flat rate of 18% on income up to $400,000. The bill also taxes puts tax on foreign income. Probably the most detrimental long term is how they're going to come after retirement accounts. So generally speaking, if you have more than $10 million, you'll be limited on how much more you can put into your IRA. And in addition to no longer being able to convert um, your IRAs over to Roths, that's a 10-year phase-in rule. But again, if you'd like more information on that, we talk about that a little bit more detail at the previous webinar. And then also doing the backdoor Roth IRA will no longer be possible after this year if you have more than $400,000 of income. Estate planning is also going to be limited. The estate tax exemption that was scheduled to come back in 2025 is now going to happen starting next year. So it's going to be cut roughly in half of the current almost $12 million exemption. And then a lot of the estate planning techniques of shifting wealth to the next generation using strategies that have been around for several decades will start to be eliminated by eliminating the use of what are typically called grantor trusts. So those are some of the highlights of the Build Back Better Act. If you'd like to have more information, definitely listen to our first webinar. And that is certainly available through the same link that you use to register for this webinar. So let's talk a little bit about what's coming next, coming down the pike. As I mentioned, this Build Back Better Act has not become law. This is when it matters to try to negotiate, with both sides, or especially the Democrats right now, trying to get to a point where they can vote on this bill at the House level, send it to the Senate. Senate will have to debate it, and then if there's any disagreement, then that goes to a joint committee to work out the differences, and then it has to go through both the House and the Senate again before it goes to the president to sign. So there are several more steps that have to take place with a relatively short time period if this is going to be affect anything this year. One of the issues that we also talked about in the other webinar is the change in the capital gains tax, which I didn't mention just a slide or two ago, but that proposal is right now the increase in that capital gains tax to 25% is effective for any capital gains after the September 13th date that the House Ways and Means Committee proposal was announced. So any capital gains that you currently are getting ready to recognize, anything after September 15th, there are some planning strategies available to mitigate that higher capital gains tax. If you sold that property before September 15th, you're still, as of right now, you're still under the old tax rate structure. The House attempted to pass the previous infrastructure bill. Now it's being held up until this Build Back Better Act is farther down the road. So as of right now, there looks like there's going to be two bills, very different bills that are going to be considered by both the House and the Senate. So it could be quite confusing if you're not tuning into which bill they're talking about. But some people are trying to get those bills passed simultaneously, just so that everybody knows what each one has, and there isn't any last minute negotiating after the first one gets passed. So this is basically where we stand. The infrastructure bill was passed by the Senate back in August. It's right now sitting in the House, waiting until the Build Back Better Act gets a little farther down the road. On the Build Back Better Act, that is waiting on the House, obviously. And then once they pass it, or whatever they pass, assuming they will, then it'll go to the Senate. That was, and then, and like I mentioned, that was introduced to the Ways and Means Committee back in September. So where we go from here is anyone's guess. Obviously, we've all been hearing and talking about, the taxes probably are going to increase. I just thought it would be, since we're going back and looking back at the legislation that started this year, I thought it would be helpful to look back in history and just see what, tax rates have been throughout the history of our income tax system. So if we look back at the history of our tax structure, going all the way back to 1913, you'll see this time period where the tax rate was relatively low, and then it started jumping up. And generally speaking, the tax increases occurred around the time of war. So around World War One, the highest marginal tax bracket jumped up into the 70% range, then settled back down in after World War One was over, and then really didn't start building back up until after the New Deal got passed as a result of the depression we had here in the U.S. and starting to raise taxes. Again, this was the highest marginal bracket, so this was what the people that had the highest amount of income in the country were paying, not the that's what some of the lower tax payers were paying. And then it really didn't it didn't really ever go back down because we then transitioned into World War II, and that was when the tax rates started going up even higher. And it was really not until around the end of World War II that tax rates went all the way up to 94% for the highest income bracket, and stayed there until really about the mid 1960s. Right about the time of after the Korean War was over, and before really the onset of the Vietnam War. But even then, the tax rate still stayed in the 70% range. So you can see that we have had about 60% of the last 100 years, 105 years, where tax rates were much higher than what we have been accustomed to. And it wasn't really until the mid 80s that tax rates started coming back down, and where they have stayed relatively low compared to the history over the last 30 to 40 years. So we have all gotten very accustomed to having relatively low historic tax brackets, especially at the highest rate. But if we go back to what it was after World War II, which as a percentage of the gross national product, that the taxes raised were actually a smaller percentage of what this current Build Back Better tax proposal is. So it's if you look at apples and apples, it is highly possible that tax rates will increase. Maybe not to 94%, but definitely it's foreseeable that if we're going to get control over the spending problems that we have in this country, they're probably deemed to go up at least 10 to 20% over the foreseeable future. And when you start breaking down how the tax structure is, which I'll go into a little bit more detail on our future webinar, is Congress has done a pretty clever job of selling all the different types of taxes that we have to pay. So depending on what income level you are, when you start looking at, okay, I've got to pay a FICA and a Medicare tax if I'm a W-2 or a business owner, up to 15.3%, and then it drops down to just the Medicare tax. So I've got to pay that tax, or my employer pays half of it and I pay half. Then you start adding your income tax at the federal level. And then if you've got investment income, you've got potentially a 3.8% net investment income tax. And if you have more than a $200,000 W-2 or a $250,000 W-2, if you're married filing joint, you also have a Medicare surtax of 0.09%. And then on top of that, you add your state income tax, which wasn't a big factor back when the federal tax brackets were in the 70 to 80 to 90%, because states generally didn't have high tax brackets except for a handful of states. Well, now you start looking at how the states are starting to tax, especially in the higher income tax states. It is it is very easy to see how somebody that's making 400 to $500,000 starts creeping into a 60% plus marginal tax bracket. So the illusion of thinking that we're in a necessarily a low tax structure right now, which sometimes takes away the incentive to do tax planning, is an illusion at best. And if this Build Back Better Act becomes law and taxes do go up, it's only going to get be worse for those people that are making more than that $400,000 amount. So as you can see, the last 18 months with the pandemic, it's caused our deficit to go even greater. At some point, that's going to have to be reconciled, and somebody's going to have to start paying for that. And the most likely way that is going to happen outside of hyperinflating that debt is which is potentially what's going on starting now, is to raise income taxes. So that's the state of where we are right now. And so, what do you do now when we're in this holding pattern of not knowing what this latest legislation is going to be like, and knowing what we already are faced with the existing tax law. So the next step would be to hopefully get a tax plan put together. If you don't know how to do one yourself, you obviously need a tax planning oriented firm. We happen to be that type of a firm at Provident. We start with a strategic blueprint where that's what we focus on as tax planning ideas, like Tyler mentioned earlier. If no strings attached, if you don't like you'll want to have us help you implement them. At least you can go to somebody else to implement our recommendations. Our goal is that you'd like what we have to say, and the fact that we are proactive and constantly looking for ways to save you money in taxes. And then if you like it, then we go through the onboarding process, implement the strategies. We're now in this very short window. Generally speaking, we have a limited time right now to get any new clients on board. Um, if you have any interest in moving forward with knowing what your options are, you can schedule a Zoom call. Tyler, if you would type in the chat box, what that link is, and people could cut and paste. That would be the fast, or that'd be the slowest way to get started. And the closer we get to the end of the year, just the time and our availability to have that 30-minute call, and then get to the next step, which is the strategic blueprint, is just going to shorten that window of time to take action. The fastest method is, to the extent that you're willing to jump out a little bit on faith. If you haven't worked with us, we do offer a strategic tax blueprint. The cost is $1,250. It comes with a 10 times guarantee, meaning that if we can't save you at least $10,000 of tax in the first year, above and beyond what you're already paying, we refund that fee to you. So it's designed to be a no loss proposition. That is available. We only have capacity right now, being at the middle of August, and for us to get the blueprints prepared with the recommendations, and then get everything finished by early December, when we need to have everything wrapped up. We only have capacity right now to accept 25 blueprints. So we're extending that offer through the end of October, if that is something that you'd like to consider. And again, Tyler, if you'll put in the link, or in the chat box, the link for someone if they'd like to just fast track and get started on their strategic blueprint.
Well, the links are in the chat. They will also be in your inbox if you registered for this webinar. If you are watching this webinar on a recording on YouTube, it will be in your description below the video.
Great. Thanks, Tyler. So, Tyler, you want to talk about what we have coming up?
All right, we have 2 webinars to close out the year. The first one will be year-end tax planning for businesses, and part 4 of this coming storm series will be year-end tax planning for individuals. But we have one caveat. If things change with the Build Back Better Act, we will provide updates as part of these 2 webinars uh, planned content. So we will do a little bit extra just to make sure everyone is up to date on those things as well. If you want to, check your inbox uh, for the email with the recording from tonight. We will always include links to the upcoming webinars in that email. So you can register for that when that email hits your inbox tomorrow. So far, we are free of questions, but the question and answer box is open. If anyone has any, we'll leave it open for a couple minutes uh, and see if any questions come in. It was a very uh, quick overview of the year, where the tax situation stands. If you have any questions around that, we'll take them.
And,
If you have any,
and just
go ahead.
as we close up, I'd like to mention, I think the next two webinars, first on tax, business tax planning, and the second is individual, will be very informative and will be very, very relevant, especially if we do have new legislation that we can start planning around. So I would highly encourage those of you who are listening to this to register for one or both of those webinars. Invite your friends and colleagues if you know anyone who might also benefit from listening to what we have to talk about.
All right. I guess we've done our duty because we don't have any questions. We must have been very succinct. Oh, I lied. We have one. Is this a good time to do a Roth conversion if we have the assets to pay for the tax from our taxable account? I am in the highest tax bracket in 58.
So it's not an easy answer. It's basically an analysis of what we first of all what we think future tax rates are, how long you're going to have that money then continue to grow inside of the Roth tax free. And since you are 58, you're very close to the magical age of 59 and a half. There are some alternatives to doing a Roth conversion that you do not have to necessarily put the money into a Roth, taking money out of a traditional IRA and rolling it over to a Roth. There's are other more tax efficient strategies out there that you might want to also consider once you reach that 59 and a half year age. So anyway, that it's not an easy answer, but there is an analysis that can be done to help you at least know what the pros and cons are of each option.
All right. Well, David, I think you are off the hook. Thank you for your time this week, and we hope we catch everyone in 2 weeks.
Great.
See you then.
Thanks, everyone.